Thank you for the introduction. So I always like to know who exactly I'm speaking to when I give these presentations. So how many of you are entrepreneurs or entrepreneur wannabes? Okay. How many of you have raised money in the past or expect to raise money for a new venture or an old venture? Okay. Any securities lawyers or bankers in the room? Okay, all right. Anyone have insomnia and come to this presentation expecting a cure? I'll see what I can do. An afternoon presentation on securities law. Okay, so we're going to talk about crowdfunding and something called Regulation D update today. It's basically the way most private companies raise equity capital. I know crowdfunding has been in the news a lot over the last 2 or 3 years, and we'll address the recent federal legislation and rules relating to crowdfunding of equity. And I gave a presentation, basically gave a version of this presentation about 2 months ago to the Northwest Energy Angels, and it was pretty snarky. So I've sort of toned it down for this audience, but feel free to raise your hand, call me out on anything I say. If you have questions, let's have a dialogue. So let's go to the first slide. And really, before we talk about crowdfunding, I thought it would be important to give you a couple of securities law basics, because it sort of sets the stage for what the crowdfunding rules are all about and why they're really not going to work very well. The first basic that you need to know is that every offer and sale of a security must be registered with the Securities and Exchange Commission, as well as with applicable state securities regulators, unless an exemption from registration exists. So the first thing you need to remember is the securities regulation system, it's a dual system. Not only do we have a federal regulator, the SEC, but each state has its own securities regulator, so that if you're selling securities in Washington and Oregon and California, you're going to have to register or qualify your offering both with the SEC as well as in each state in which you're going to be taking money from investors, unless an exemption applies. So what we're focused on here are the exemptions, okay? When companies go public, IPO, go public, or sell securities in a follow-on offering, what they're doing is they're registering their securities with the SEC and going out and becoming a public company or raising money from the public. Most capital is raised in private transactions, private placements, and that's what we're talking about, exemptions. Now, there are 2 types of exemptions. First type of exemption relates to exempt securities. These are securities that are basically regulated by some separate regulatory body, such as, for example, insurance contracts. Well, each state has an insurance commissioner. So Congress, in its infinite wisdom in 1933, decided that the federal government was not going to regulate insurance policies, insurance contracts. They would exempt those contracts from the definition of security and let the state insurance commissioners regulate those contracts. So things like government bonds, state guaranteed securities, most bank securities, insurance contracts, securities issued by nonprofit organizations, all of those securities are exempt securities, and if an entity sells them, they don't need to be registered with the SEC and in most cases with the states. The other type of exemption relates to transactions, and we're going to focus on the private placement exemption, which in the statute is not an offering not involving a public offering. There are other exempt transactions. For example, you call up your broker and you're going to sell 100 shares of IBM. There's an exemption for that type of ordinary course trading transaction. But really the transaction that we're focused on is transactions not involving public offering. Okay? Now, the next basic issue is that when the federal government, when the Congress adopted the securities laws in the 30s, they decided they weren't going to go down the path of having the regulator review a securities offering document for its merit. But what they wanted folks to do is disclose to the investor, so the investor can make up his or her mind whether to purchase the security, all relevant information, all material information relating to the security and the business and the operation of the company. So another basic requirement is that the issuer must disclose information that's material to the investor's investment decision. For non-exempt public offerings, that's the prospectus or the registration statement. And I just grabbed, before I left the office, the Groupon prospectus. This is a 170 pages of text, followed by another 100 pages of financial statements and notes. And so for a public offering, a non-exempt transaction, a company would put out something like this, prospectus as a disclosure document. For exempt transactions, for private placements, it really depends on which exemption the company is relying on, the target audience, and we'll get into that in a moment, whether you need a fancy document for marketing purposes to attract investors, as well as the issuer's risk appetite. And what I mean here is that it's possible to rely on a private placement exemption and sell only to rich people without giving them any disclosure whatsoever, or give them a one-page term sheet. And many companies do that. For certain types of companies focused on a small number of accredited investors, I'll call them rich people, you're not required to provide any disclosure whatsoever. Alternatively, if you're selling to widows and orphans and students, poor students, who aren't accredited investors, then there are disclosure requirements. And alternatively, you could have a large company selling to very sophisticated investors, a handful of sophisticated investors, and because of the risk appetite of the issuer and for marketing purposes, even though the company is not required to provide any disclosure, they provide the investor with a disclosure document that looks pretty much like a public company offering document. This is a private placement of junk bonds by a Washington company. We worked on this one. It was sold to 20 insurance companies and hedge funds. And just like the public company document, this has about 130 pages of disclosure, followed by 40 or 50 pages of financial statements. This is at one end of the spectrum on the private placement disclosure requirement. So the disclosure requirement really runs the gamut from, for certain private placements, no disclosure required. For others, mandatory disclosure, and for others, optional disclosure like this. Okay, I wanted to focus on Reg D and Rule 506 for a moment, because really this is the exemption that virtually all early stage companies rely on. In fact, most private companies rely on in raising equity capital, and many public companies rely on in raising equity capital when they're not going through a public offering. It's a pretty flexible exemption from registration. You can raise an unlimited amount of cash from an unlimited number of accredited investors. We'll come back to that in a moment. You're not required to provide any disclosure at all if you're raising cash from accredited investors only. And if you rely on this exemption and you satisfy its requirements, you're not subject to any state regulation whatsoever. So very handy, used all the time. The one drawback to this regulation is until recently, the issuer was not permitted to engage in any general solicitation or advertising in connection with the offering. And we'll come back to that element in a moment. But that's the classic private placement exemption that is used all the time by lots of companies, large companies, small companies, early stage companies. And in fact, that was the exemption that this company relied on for its $455 million junk bond offering. Okay, let's spend a little bit of time just focused on what it means to be accredited, because folks ask this all the time. You saw that for Reg D purposes, you can raise an unlimited amount of cash from an unlimited number of accredited investors. And again, what the SEC has said is, well, we're going to define a category of rich people and assume that if they meet these net worth or income requirements, they're by definition smart and they know what they're doing. So we don't really have to worry about ensuring that they received disclosure. Additionally, for entities, there's an asset test, and an officer and a director of a company is always deemed to be an accredited investor. So if you're an officer or director, you're accredited with respect to your company, regardless of whether you satisfy the income or the asset test. General solicitation. This is pulled right out from the regs, but basically, and you can see it, this reg was written sort of in the pre-internet era. But basically, if a company engages in any sort of public announcement, public advertising of its offering, that's general solicitation. And if a company engages in general solicitation, it can't rely on that Reg D exemption. So the question always is, first of all, is the issuer or someone acting on its behalf using a communication to offer securities? Because sometimes a company may have a ordinary course public announcement about a new product or hitting some sales figures or so forth, even in the midst of a securities offering. So the question there is, well, is that communication really an offer to sell a security? And then secondly, is the communication a general solicitation? And so at one end of the spectrum, right, you can talk to your neighbor about your company and the fact that it's raising capital. Doesn't seem like a public solicitation to me. On the other hand, you go out and tweet or put something on Facebook or LinkedIn, that's general solicitation. But in between there's this big gray area that securities lawyers always worry about. Is this a solicitation or isn't? And there's been, endless numbers of articles and commentary about this concept. And the SEC in September liberalized Regulation D to take into account the decades of commentary on this general solicitation prohibition. We'll come to that toward the end of the presentation. Okay, so now the topic that you've come here to hear about, crowdfunding. I think probably everybody knows what crowdfunding is, at least in the sort of Kickstarter and Indiegogo world. Has anybody engaged in, participated in crowdfunding opportunities? Yeah, okay. I mean, I think folks understand what that means now. In fact, I went on to Kickstarter before putting this together just to see what, a sample of some of the opportunities that are available for funding. There's a limited edition photo book on Soviet bus stops that folks are looking to raise money for. It's a photo book showcasing the most mind-blowing collection of creative bus stop designs from the Soviet era. Okay. How about this one? Sole socks. Replace your socks with our custom insole that absorbs moisture and odor from the foot to keep your feet and shoes smelling fresh. And then, my favorite, this one comes from Seattle. Campus Beer Run 3D. drunk college endless runner game app. Okay, so you can go on Kickstarter today and click on a donation amount and contribute to the realization of dreams for these entrepreneurs. And really what you're getting when you do that, right, is you're getting a reward of some sort, either a psychic reward because you're donating to a good cause, or you're pre-purchasing a product, right? You're going to get a copy of the app when they're finished with it. You'll get a copy of the bus when it's published, the bus stop book when it's published. But what you're not doing is purchasing an ownership interest in that company. You're purchasing a reward or basically giving a charitable donation. So folks got all excited about, crowdsourced funding and said, well, if it works for, funding films and games and restaurants and so forth, let's use it to fund, equity raises by companies. Next slide. So in 2012, as part of the Jobs Act, Congress decided to adopt Title III, a crowdfunding exemption, which was geared to expanding and easing capital raising by small companies and trying to relax the regulatory burden of producing a elaborate disclosure document requiring filings and so forth. And the bill dragged on for a little bit, but it was finally enacted in April of 2012. Congress laid down a few requirements and then punted to the SEC to adopt a whole number of implementing regulations. And they gave Congress 270 days from April 2012 to get those regs final and published. So sometime later, next slide. Well, yeah, let's see what the law said first, and then we'll talk about the regs. So what the law actually says is that eligible issuers may raise up to $1 million during a rolling 12-month period without worrying about registration. And they can do that from qualified investors, that's a defined term, special term, through a broker or a funding portal, and all of this is subject to the company's satisfaction of certain disclosure requirements. So the SEC was supposed to issue regs in January of 2013. They were a little late. They were actually issued in October. The regs are almost 600 pages long, and the public comment period ended on February 3rd of this year. So, according to a Wall Street Journal report last week, the SEC staff is just now beginning to review the public comments on the proposed rules. So if anybody's excited about running out and doing a crowdfunding offering, remember it's still illegal. It's unlawful until the SEC actually issues final rules. When will that be? Hard to know. Probably by the end of the year, I think what most folks believe. So let's turn now to the law and look at some of those elements in the actual Jobs Act provision. And the first element that we'll look at are the investment caps for investors, because remember the law said that companies can raise up to $1 million during a rolling 12-month period from eligible qualified investors. And what Congress has basically said is that, well, we're going to protect the investing public from being ripped off up to a certain cap amount. So if your net worth or annual income exceeds $100,000 a year, the investor may invest up to 10% of his or her income or net worth up to a maximum of $100K. So your exposure is capped at $100K for any 12-month period if you're income or assets are over 100K. For poor people, for income under 100K, Congress has said, well, we're really worried about those folks, those widows and orphans and people who earn under 100K. They're by definition not sophisticated, don't know what they're doing. So we're going to cap their exposure at the greater of $2,000 or 5% of their income or assets, which basically means you have a $5,000 cap for investors whose income or assets are under 100K. And those caps apply to the total amount of investment in crowdfunding offerings during any 12-month period. That's policed by the funding portal or the broker that we'll come to shortly. Here we go. Congress, another element of the law was that all these crowdfunding offerings have to go through these funding portals or brokers. And there's been a tremendous amount of dialogue in the community about what this means. I would say about 300 pages of that 600-page proposed regulation relates to these funding portals. But basically, the concept is that all crowdfunding offerings under the SEC regime have to be funneled through a portal, and the SEC has basically imposed a number of obligations on the portal to make sure that the risk of fraud is minimized. These brokers and portals have to be registered. That's a big deal. It's very expensive. So the portals are going to be subject to a whole separate regulatory regime, both governed by the SEC as well as by FINRA, which is the self-regulatory body that basically governs all investment banks and financial institutions. And the broker funding portal, has a number of due diligence requirements relating to the investors. All the disclosure has to be channeled through the portal, and they have to undertake a number of measures to minimize the risk of fraud. Of course, these portals are going to be charging issuers that want to use crowdfunding a nice hefty fee. And we're going to come to that in a moment, but no such thing as a free lunch. The fourth element of the law relates to disclosure, and this is probably the biggest deal. What the law basically says is that if you want to undertake a crowdfunding offering, you need to prepare a document that basically looks like this. Okay? It's pretty significant disclosure burden, requiring the issuer to include all sorts of information about the company, its business plan, bios of its management and directors, the way it's going to use the proceeds, and so forth. So it's a pretty robust disclosure document. Another interesting element of this disclosure requirement is that if your offering is for 500K or more, you need to go get audited financial statements. Now, on the one hand, if you're an early stage company or a startup that wants to engage in crowdfunding, what do your financial statements look like? They're one page, it's a one-page document, basically. So what is there to audit? So, from that perspective, maybe that's not such a big burden, but, if you have some traction in the market and, you have something more to show on the financials, requiring audited financials or even reviewed financials, which is a lesser, for any CPAs out here, it's a lesser standard of review. Another expense, more delay, and more red tape to go through in this disclosure process. And then, if you're successful with your offering, you're required to file basically an annual report with the SEC, and to post that annual report on your website, including financial statements. And for those of you who have worked with emerging growth companies in the past, guess what? Most of those companies aren't really eager to post their financials to the public or provide the type of information to the public that you'd see in a public company document. So this is a big deal, big expense, big time commitment. And next slide, if you don't do it right, pretty high likelihood of being sued because the anti-fraud rules always apply, whether you're a registered offering or an exempt transaction. If you have a material misstatement or a material omission of fact in your offering document or in your oral statements to investors, what does that mean? I don't know. It means what the plaintiff lawyer says it means, what's material, etc. You're at some risk. So for emerging growth companies, a startup wants to get out there and do a crowdfunding offering, all of a sudden you're talking about a big fat offering document for which you have full anti-fraud liability. It's a problem. Now let's go back to the classic private placement exemption again. This same slide as I showed before. The issue about this exemption with respect to crowdfunding, of course, is that this exemption is limited to accredited investors only and up to 35 non-accrediteds, and no general solicitation or advertising permitted. In a crowdfunding deal, of course, you would expect there to be more than 35 non-accrediteds, so it blows you out of this exemption. And by definition, you're going to be engaged in general solicitation or advertising. So that's why this exemption wouldn't work in a crowdfunding context. But in September, next slide, the SEC liberalized Regulation D, and issuers are now permitted to engage in general solicitation if they satisfy these three conditions. Still stuck with accredited purchasers only. So an issuer can go out, use the internet, put up a billboard on I-5, newspaper ad announcing the offering, but they still can only take money from accredited investors. In addition, the issuer has to take reasonable steps to verify the accredited status of the purchasers. That's sort of a big deal. I'll come to that in a moment. And then they have to satisfy the other requirements of Reg D. So the SEC liberalized Regulation D, but it still doesn't work for a typical crowdfunding offering in the context of putting something out there on the internet and taking money from all comers. Just quickly, a comparison between the classic Reg D, Rule 506 offering, and the new Reg D, Rule 506 offering. And by the way, they both still can be used. So there are good reasons, and a sort of table summarizes why. There are some reasons why an issuer may still want to engage in a Rule 506 private placement without general solicitation. In a classic private placement, all the investor has to do is self-certify, I'm accredited. And if the issuer has no reason to believe that that's a misstatement, they can accept that self-certification. But under the amended rule, the issuer has to do certain things to verify the status of the accredited investor, possibly look at tax returns, financial statements, get a brokerage account. So this has been much written about in the securities community because it imposes some additional burdens on the issuer. If you want to bring in non-accredited investors, you can't solicit because only accredited investors may participate. And this is a technical issue, but if you blow the requirements of the new Rule 506, then you could have some technical securities law risks. And then there's still a market perception, I think, that if a company has to go through the trouble of engaging in general solicitation or advertising, maybe it's not such a great bet for the investor, because why can't they just go around the community and find some investors who have the dough and willing to step up for an investment. I wanted to throw up some slides that compared the crowdfunding exemption and the new Reg D Rule 506 exemption. just to sort of compare what we have here. These are little trophies, so it's supposed to designate who wins on each of these elements. So offering size in a crowdfunding deal, you're capped at $1 million in any 12-month rolling period. There's no limitation under Rule 506. Again, investment amount, there's a cap on the amount that investors can contribute in a crowdfunding deal. No cap over here in Rule 506. Required intermediaries, crowdfunding deals all have to go through those portals. No such requirement for a Rule 506 deal. Again, mandatory disclosure. Yes, a big fat disclosure document for the crowdfunding offerings. No mandatory disclosure requirement for a Rule 506 offering, except for a very simple post-sale filing with the SEC. Continuing reporting obligations. Yes, crowdfunders, you're going to have to file those annual reports with the SEC, get your annual report on the website. No such requirement for Rule 506. Here's really the only category where crowdfunding works better than Rule 506, right? Investors, you can offer it to the world. Here, you can offer it to anyone, but you can only take dough from accredited investors. Again, sort of same issues, investor verification, that burden's imposed on the funding portal. Here you have an issuer obligation, so it's sort of a wash. One more. Marketing, everything has to go through the funding portal. Issuer can do it all here. Preempt state law, yes, they both do. We're going to come to this in the next slide, I think. Very expensive because, again, crowdfunding offering, you're capped at $1 million over a 12-month period. And, you know, I think I've sort of quickly demonstrated what you need to do to get there and comply with the exemption, with the disclosure, potentially an audit or reviewed financial statements. You know, you're going to have to engage with the funding portal, which will probably charge, you know, 5 to 10% of your raise. So very, very expensive money. Here, relatively low, assuming you're not going to have to generate a big fancy offering document. But even so, because you can raise an unlimited amount of cash, it's relatively low cost money. And of course, can I use it now? Crowdfunding, no. Rule 506, yes. So, you know, the bottom line from my perspective on crowdfunding, forget about it. Forget about it. It's going to be a dead letter, regardless of what the SEC regs say, because it's simply going to be too expensive for most companies to use, and also time consuming because you know, you have the securities liability for bad disclosure. You have a potential risk of the state regulator coming in and saying you did it the wrong way. And I've referenced this. There are a number of analyses out there on the web. This is one analysis by an angel group called Seed Invest. And let's see, I wrote down some of their data points. They have a sort of interactive spreadsheet that you can go on and modify some of their variables, but they are basically estimating that it will cost between $140,000 and $250,000 to complete $1 million raise using the crowdfunding model. You know, they're estimating that $100,000 crowdfunding raise will actually result in negative cash flow of about $40,000 due to the costs of putting it all together. And you know, another commentator has noted that, you know, it's basically death by expense. So it's real disappointment, I think, for a lot of folks who viewed crowdfunding as you know, a great model for small companies trying to reach lots of small investors to raise equity capital. I just don't think it's going to happen. at least for most companies. Now, I did want to note that there are some states that have adopted their own crowdfunding legislation, and Washington is one of the states that's currently considering a crowdfunding exemption. The problem is that these exemptions only will exempt intrastate offerings. So that means that you can only raise money from residents of that particular state. And some of these exemptions actually require that the company be organized in the state. So, if you have a Delaware corporation or an Oregon corporation, you wouldn't be able to rely on, for example, the Georgia or the Kansas state exemption. So this is, you can see something like this being used by maybe a real estate developer or a retail concept with one or two stores in a state. But for most companies, that are incubated here, this is not terribly helpful. These state exemptions really have tried to put into effect the concepts that I threw up on one of the early slides, which is basically, let's reduce the regulatory burden. We're not going to require, big disclosure documents. We're not going to require filings with the state. We'll put in some modest offering and investment caps, and otherwise try to reduce the regulatory burden. But at the end of the day, you probably are not going to see these state exemptions used, all that successfully by most companies.
How are the states able to have exemptions to the federal regulations?
Thanks for that question. One category of exempt security under federal law is a security that's sold wholly intrastate. So there's an existing federal exemption for intrastate offerings, basically. Sorry, I'd be delighted to come back when we see some final regs and we see what folks are talking about to see if there's, a more optimistic outlook I can provide. But it's going to be an exemption that I think is going to be a dead letter because of the burdens that SEC can't change because it's already baked into the law. So, thank you.